Have you ever wanted to own a piece of the entire stock market or maybe even a vault full of gold with just a single click? Well, today we're diving into the tool that makes that possible, the Exchange Traded Fund, or ETF. It's an invention that has completely changed the game for investors, and we're about to find out exactly how. So here's how we're going to break it down. First, we're going to jump back in time to the beginning of the ETF revolution. Then, we'll peek under the hood and see the clever mechanics that make these things tick. After that, we'll follow their incredible journey from simple stock funds all the way to crypto. And finally, we'll get practical and talk about strategies for building a truly modern portfolio. Okay, let's kick things off with the ETF revolution. So what was it about this new idea that made it such a game changer? Why did it offer a better way to invest? At its core, the concept is beautifully simple. Just think of an ETF as a shopping basket, but instead of groceries, it holds a whole collection of assets. It could be stocks from hundreds of different companies, all sorts of bonds, or even physical stuff like gold. And the best part? You can buy or sell that entire basket on a stock exchange in one go, just as easily as buying a single share of a company. And this is really where ETFs started to pull away from the pack. See, they were basically designed to fix the biggest problems of their older cousin, the mutual fund. Mutual funds, they only get priced once at the end of the day. But ETFs, they trade all day long, just like a stock, which gives you way more flexibility. And on top of that, they almost always have lower fees, and, especially in the US, they can be a whole lot more tax efficient. And wow, the evolution has been fast. It all kicked off back in 1993 with the legendary SPDR S&P 500 ETF, which everyone just calls SPDRs. A decade later, bond ETFs hit the scene. By 2008, you could even get actively managed strategies in an ETF wrapper. And then in 2024, the whole game changed again with the approval of spot Bitcoin ETFs. It's just been 3 decades of non-stop innovation. Okay, so that brings us to the really cool part. How do these things actually work? What is the secret sauce that lets this basket trade like one stock, while its price perfectly tracks the value of all the different things inside it? Well, the magic ingredient is a really powerful idea called arbitrage. All it means is making a profit from tiny, temporary price differences for the same thing in different places. For ETFs, this isn't just some clever trading trick. It's the absolute core engine that makes sure the price you're paying is always fair and accurate. It all happens through this elegant process called creation and redemption. Let's say an ETF's price on the stock market starts to drift away from the real value of the assets it holds. Well, these huge financial institutions, called Authorized Participants, see a risk-free profit opportunity. They jump in to either create a big block of new ETF shares or redeem a block of old ones. That action instantly adjusts the supply, and poof, it yanks the price right back where it's supposed to be. It's this amazing self-correcting system. All right, and that brings us to our third section. Because that incredibly flexible structure has allowed the ETF universe to grow in ways its creators probably never, ever dreamed of. Seriously, if you can dream up an investment idea today, there is probably an ETF for it. You can buy the entire market, a basket of bonds, a pile of gold, a portfolio of foreign currencies, you name it. You can bet on big ideas like robotics or clean energy, or even get into some really complex strategies using leverage. The menu of choices is just staggering. And get this isn't just some paper promise. Take a famous commodity ETF like SPDR gold shares. It doesn't just track the price of gold. It physically owns the stuff. We're talking about more than 40 million ounces of actual gold bars sitting in a vault, held in trust for its investors. And the innovation just keeps coming. The approval of spot Bitcoin ETFs in 2024 was a huge moment. It applied this exact same structure to a totally new kind of asset. For the very first time, people could get direct exposure to Bitcoin inside a traditional, regulated investment product. Which brings us to our final and maybe most important section, building a modern portfolio. Because look, knowing what an ETF is, that's one thing. But knowing how to actually use them to build a smart strategy, that is everything. So I want to start with this really provocative quote from Warren Buffett. He's challenging that old advice that you should just own a little bit of everything. And it's the perfect way to start thinking about building a portfolio today. We're just buying a bunch of different funds and hoping for the best. Well, that isn't enough anymore. So the key is understanding what you actually own. The old school 3-fund portfolio was super simple. US stocks, international stocks, and some bonds.
Done. But today, it's really easy to fall into a trap some people call diversification. You might buy two really popular ETFs, say Q2Q, which tracks the big tech companies on the NASDAQ, and VTI, which tracks the whole US market, and you think you're diversifying. But you might not realize just how much those two funds overlap.
And I mean, check out this number. A staggering 93% of the stocks in the tech-heavy QQQ are already inside the broader VTI fund. So if you own both, you're not really diversifying your risk as much as you think you are. You're mostly just doubling down on the very same large US companies. Understanding this kind of overlap is absolutely crucial. Of course, strategy is not one size fits all. The way we've been talking is pretty US focused, and that can be a major blind spot. So, what do these principles look like if you're an investor outside of the United States? Well, this is a huge deal. If you're a European investor and you buy a standard all-world ETF, you might be shocked to learn that over 60% of your money is now concentrated in a single country, the USA. That exposes you to a lot of risk tied to one country's economy and one currency. So a common strategy to fix this is to add what's called a home bias. For example, that European investor might keep their global ETF, but then also buy another ETF that only focuses on European stocks. This helps them rebalance the portfolio, pull back some of that heavy US concentration, and better align their investments with their own economy and currency. And that really brings us to the golden rule, no matter where you are in the world. Smart investing is not about just copying what someone else is doing. It's about understanding your own goals, doing a little homework to know exactly what's inside the ETFs you're buying, and then building a strategy that is right for you. So, from a simple basket of stocks back in 1993 to a global multi-trillion-dollar industry today, the ETF has proven to be one of the most powerful and adaptable tools an investor has ever had. The only question left is, now you know the tool, what are you going to build with it?